Welcome back to the channel, Future Financial Pros. Today, we're diving deep into an incredibly unique hard-to-borrow situation that recently popped up on our screener. We're going to dissect NCT, a microcap stock with a truly eye-watering cost-to-borrow fee, and explore what that could mean. This isn't just about identifying potential opportunities, it's about understanding the complex mechanics behind short squeezes and why certain stocks become incredibly expensive to short. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about NCT. This is a fascinating and somewhat enigmatic microcap company. The sector for NCT is currently listed as N/A, which often means it doesn't fit neatly into traditional categories or its primary business isn't immediately obvious from standard classifications. Now for the critical data points. When our screener flagged NCT, it was due to an astounding annualized cost-to-borrow fee of 677.5%. That's not a typo, 677.5%. The estimated float for NCT is a tiny 0.3 million shares. This extremely low float is a crucial factor in understanding why a stock can become hard to borrow. However, it's absolutely vital to highlight NCT's recent price and volume action. Today's change was plus 0.0%, last 5 days plus 0.0%, and last 30 days also plus 0.0%. Today's volume was 0 shares, with a 30-day average volume of 0 shares, leading to a relative volume of 0x average. This means NCT has seen effectively no trading activity recently. What is cost to borrow and why it matters? So, what exactly is the cost to borrow, or CTB, and why does a number like 677.5% matter so much? When you want to short sell a stock, you first need to borrow shares from a broker. The cost to borrow is the annualized fee you pay to keep those borrowed shares. Think of it like renting a car. If everyone wants to rent a specific rare car, the rental fees skyrocket because there are so few available. The same principle applies to shorting stocks. When a stock becomes hard to borrow, it means there is high demand from short sellers to borrow its shares, but very few shares are actually available. This scarcity drives the CTB fee through the roof, often exceeding 100% annually, meaning short sellers could pay more than the stock's value just to maintain their possession for a year. A high CTB indicates strong conviction from short sellers, but also increasing financial pressure on them to close their positions. Why this stock is hard to borrow right now? For NCT, with its annualized cost to borrow soaring to 677.5%, it's clear this micro-cap stock is incredibly hard to borrow right now. This is primarily driven by its minuscule estimated float of just 0.3 million shares. A small float means there are very few shares circulating and available for trading or borrowing. If even a moderate number of shares are being shorted, the supply of available shares to borrow quickly diminishes, pushing that CTB rate sky high. However, and this is a critical distinction for NCT, while our screener identified it due to these extreme borrow conditions, the total lack of recent trading volume means that these borrow dynamics aren't currently playing out in an active market. There are essentially no shares changing hands, which means no immediate short covering pressure from active trading. Chart flatline. Squeeze mechanics explained. Despite the current inactivity, understanding the mechanics is key. A short squeeze occurs when the price of a heavily shorted stock rapidly rises, forcing short sellers to buy back shares to limit their losses. This buying action further pushes the price up, creating a cascade. For a stock like NCT, if trading activity were to resume and some positive catalyst emerged, the extremely high cost to borrow and tiny float could theoretically create an explosive situation. Short sellers, already bleeding 677.5% annually, would face immense pressure to cover. Their forced buying would quickly dry up the limited supply of shares, sending the price soaring. However, it's vital to remember that a high cost to borrow loan does not guarantee a squeeze. It can also signal that short sellers have very strong conviction that the stock's price should fall, and they are willing to pay those exorbitant fees to maintain their bets. Dilution risk check. When evaluating any potential short squeeze candidate, a critical step is checking for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can decrease the value of existing shares. Our dilution risk check for NCT found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. We also found no recent reverse split for NCT in our look-back window. This is generally a positive sign because dilution can completely offset or negate a short squeeze thesis. New share issuance increases the supply of shares, giving short sellers more options to cover their positions or even new shares to short, which counteracts any buying pressure that might come from a squeeze. So, in NCT case, at least based on recent filings, there's no immediate dilution threat. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given NCT unique profile, a microcap with an incredibly high 677.5% cost to borrow and a 0.3 million share float, yet zero recent trading volume or price movement, what should you watch for? The first and most critical factor would be any resumption of trading activity. Without volume, a squeeze simply cannot materialize. If you start to see even small amounts of volume come in, paired with any upward price movement, that would be the initial signal. Beyond that, continue to monitor NCT cost to borrow to ensure it remains elevated or even increases, and keep an eye on the supply of shares available to borrow. A shrinking supply combined with renewed interest would strengthen a short squeeze thesis. Remember, the current data for NCT highlights an extreme theoretical short squeeze setup due to the borrow rate, but it lacks the active trading market needed for such an event to unfold right now. NCT presents an incredibly compelling example of a stock with extreme hard-to-borrow conditions, driven by its microcap status and tiny float. The 677.5% annualized cost to borrow is undeniably a red flag for short sellers, and our composite squeeze score of 42.5 reflects that underlying potential. However, the current reality of zero trading volume means NCT isn't an active squeeze candidate today. It serves as a fantastic educational case study for understanding the power of supply and demand in the borrow market. Keep these mechanics in mind as you explore other hard-to-borrow situations. If you found this breakdown of NCT insightful, please hit that like button, subscribe for more in-depth stock education, and let us know in the comments if there are other hard-to-borrow stocks you'd like us to cover. We love hearing from you. Until next time, stay disciplined and happy trading.